You think the economy is doing just fine and your retirement fund is perfectly safe, but behind the scenes, the biggest asset managers on earth are quietly freaking out because the multi-trillion-dollar private credit bubble is officially starting to explode. Before we dive into how Wall Street has been selling you garbage lending disguised as safe yield, do me a quick favor and drop a comment right now with your current age and the exact amount of money you manage to invest every single month. Seriously, type it out down below. Because we need to know who is actually building wealth and who is just sitting on the sidelines getting eaten alive by inflation. The Department of Justice is now actively probing valuations at a BlackRock private credit fund, and that single sentence should stop every single regular investor cold. This is not about BlackRock disappearing because it won T, and it is not even about proven criminal wrongdoing just yet. The real story is that the biggest problem in private credit is exactly what the government is probing. Valuations for years. These massive institutions told you that private credit was a magical wonderland where you could get high yields with low volatility because these loans do not trade every second on the public stock market. They called it a feature, but it is actually a massive bug that critics call mark to myth because when there is no active market price, the fund manager gets to literally make up the model and decide what the loan is worth. If the model says the loan is worth 98 cents on the dollar, the fund looks completely healthy, but if the actual market would only pay 80 cents, that is a completely different story. Now that the economy is slowing down and interest rates have crushed corporate cash flows, the illusion is shattering. Carlyle just cut its business development company dividend. Blue Owl is frantically spending $85 million to buy back its own sinking shares to artificially prop up its stock price. And powerhouse firms like KKR and Apollo are scrambling to tackle what they call problem funds. This is exactly what stage 2 of a massive credit crunch looks like when trust completely breaks down and people realize that the emperor has no clothes, when everyone was trying to deploy trillions of dollars into the same private loans over the last few years. Underwriting standards inevitably turned into absolute trash. They lent money to zombie companies using dangerous structures like payment in kind, which means instead of paying cash interest, the broke borrowers just added more debt to their balance sheet. Wall Street packed this toxic waste into alternative products and sold it to pension funds, insurance companies, and wealthy individuals who were desperate for yield. But now the cycle has turned. The exit markets are completely frozen, and the marginal borrower is completely broke. If the absolute biggest names in finance are neck deep in this garbage, just imagine how much toxic waste is hiding in the smaller, less transparent funds. This is exactly why regular people get absolutely slaughtered in public markets, because they act as the ultimate exit liquidity for institutional scams. If you want to achieve true financial freedom and avoid getting wiped out by these massive corporate cycles, you have to completely reject the Wall Street hype machine, stop trying to chase complex alternative investments or timing the market. Because time in the market will always beat timing the market. If you want to accumulate millions of dollars over the long term, you need absolute discipline, aggressive saving habits, and a dedication to dollar cost averaging. You do not need a fancy hedge fund. You just need to live far below your means, maybe drive a beat-up 2006 sedan. Live in a minimalist apartment and aggressively pump every single spare dollar into simple, transparent, low-cost index funds, like VOO to capture the entire stock market growth, or SHD if you want high-quality dividend growth from real companies that actually produce massive cash flow. Instead of accounting illusions, max out your Roth IRA every single year so your wealth compounds completely tax-free, and let the unstoppable power of compound interest do the heavy lifting over the next 10, 20, or 30 years. The private credit market is moving from a phase of trust me to a phase of show me, and as the banks pull back, collateral values drop, and regulators expand their investigations, the credit machine is going to grind to a halt, affecting the real economy and public stocks. When the market inevitably panics and drops, that is not your cue to sell. It is your golden opportunity to buy real assets at a massive discount while the overleveraged institutional players go bankrupt. Build your emergency fund, cut your stupid consumer spending, stay disciplined with your weekly or monthly automatic investments, and let the broken system work in your favor over the long run. This transition from simple credit losses to a full-blown funding and withdrawal crisis is exactly how the macro machine turns a small spark into a massive bonfire. Regular retail investors get blinded by flashy presentations promising stable 12% returns without the daily volatility of public stocks, but they never ask themselves where that return actually comes from. If a regular bank refuses to lend money to a company at an 8% interest rate, why is a private credit fund stepping in to lend to them at 14%? It is because that corporate borrower is highly risky, highly leveraged, and unable to secure traditional financing. During the easy money era, when central banks kept interest rates near zero, everybody looked like a genius. Companies could easily borrow more money to pay off their old debts, and asset managers could pretend their portfolios were completely pristine. But today, in 2026, we are seeing the delayed reality of years of reckless monetary expansion. The chickens are finally coming home to roost. And the foundations of these private credit funds are cracking under the weight of high interest rates. When a fund manager marks an asset based on an internal spreadsheet rather than an open market transaction, it creates a massive dangerous gap between perception and reality. This gap works beautifully on the way up, but on the way down, it creates a sudden liquidity trap. Imagine you own a house and you tell everyone it is worth $1 million because your neighbor sold their house for that much 3 years ago. You feel incredibly wealthy, you borrow against that valuation, and you plan your entire financial future around that number. But when you actually try to sell the house because you desperately need cash, the only buyers in the market offer you $600,000. Your entire financial structure instantly collapses because your personal valuation model did not match economic reality. That is exactly what is happening inside these multi-billion-dollar private credit portfolios right now. Banks that provide leverage to these private funds are starting to realize that the collateral backing their loans is severely overvalued. When a bank decides that a 98-cent mark is actually worth 80 cents, they do not just sit around and wait, they demand more collateral, they increase the haircuts, and they restrict further funding. This triggers a massive vicious loop where private funds are forced to hoard cash, halt investor redemptions, and dump their best assets at fire sale prices just to survive. We saw this exact same playbook during the banking panic of 2023, and we are seeing the early stages of it play out right now across the private asset landscape. As a regular retail investor, your biggest advantage is that you do not have to participate in this game of institutional musical chairs. You do not have to answer to impatient limited partners. You do not have to manage billions of dollars of toxic debt. And you do not have to lie about the value of your assets to protect your fee income. You can look at this chaos, completely ignore the noise, and focus on basic wealth-building fundamentals that have stood the test of time. For over 100 years, the absolute best thing you can do right now is to aggressively optimize your personal cash flow savings rate. Look at your monthly bank statements and cut out every single piece of useless consumer crap that is draining your net worth. If you are spending hundreds of dollars a month on premium subscription services, expensive dinners out to impress people you do not even like, or financing a brand new luxury vehicle that loses 20% of its value the moment you drive it off the lot, you are actively sabotaging your financial future. You need to adopt a radical mindset of aggressive accumulation, drive that older car until the wheels fall off, live in a simple apartment that costs a fraction of your income, and view every single dollar you save as a soldier that goes to work to build your wealth empire. Once you have cleared out the consumer garbage and built a solid 6-month emergency fund in a high-yield savings account, you put your investing plan on absolute autopilot. You do not try to guess when the stock market will hit its bottom, and you do not try to swing trade individual tech stocks based on internet hype. You implement a strict dollar cost averaging strategy into a broad market index fund like VOU, which tracks the 500 largest, most profitable companies in the United States. When you buy VO, you are buying real businesses with real revenues, real products, and real cash flows. Companies like Apple, Microsoft, Amazon, and Nvidia do not get to mark their assets to myth on a private spreadsheet. Their values are constantly tested by millions of global participants every single second. When the market goes down, your automated monthly contribution buys more shares at a cheaper price. When the market goes up, your existing shares become more valuable. You do not need to be a financial genius to win this game. You just need the discipline to keep buying month after month, year after year, completely regardless of what the scary headlines on the news are saying. If you prefer a strategy focused on consistent income and dividend growth, you can split your contributions with an exchange-traded fund like SHD. This fund specifically targets high-quality U.S. companies with a proven track record of paying and growing their dividends over time, unlike the fake yield promised by private credit funds that use payment-in-kind gimmicks. The dividends from SHD come from actual cash profits generated by mature sustainable business operations. This cash is deposited directly into your brokerage account, allowing you to either reinvest it automatically to buy more shares or use it to cover your living expenses. To supercharge this strategy, you must utilize tax-advantaged accounts like a Roth IRA. In a Roth IRA, you contribute after tax dollars, but your investments grow completely tax-free, and your withdrawals in retirement are also 100% tax-free. This means when your automated investments compound over 20 or 30 years into a multi-million-dollar nest egg, the government cannot touch a single dollar of your capital gains. It is the ultimate legal tax shelter for the average working-class citizen, and yet millions of people fail to maximize it every single year because they are too busy looking for a get-rich-quick scheme. Wall Street wants you to believe that investing is incredibly complicated and that you need their high-fee alternative products to achieve financial freedom. They want you to get scared by the current macro environment, so you hand over your hard-earned money to their actively managed funds. But history shows that over 90% of active fund managers fail to beat a simple low-cost index fund over a 15-year period. They collect their massive management fees whether they make you money or lose your money, while you take on all the underlying risk by taking control of your own personal finance, maintaining a high savings rate, and consistently executing a simple, long-term investment plan. You effectively opt out of the corporate exploitation machine. The private credit meltdown that is currently catching the attention of the Department of Justice is just another chapter in the long history of financial market cycles. Bubbles always expand on a wave of cheap credit and blind optimism, and they always burst when reality forces its way back into the room. The current escalation from isolated bad loans to structural valuation probes at institutional giants like BlackRock confirms that the era of easy money is completely over. The coming years will likely bring increased market volatility, credit tightening, and economic friction as the system cleanses itself of the toxic leverage accumulated over the last decade. Do not let this reality panic you. Instead, let it empower you. While the overleveraged institutions and the undisciplined consumers get crushed by the weight of their own bad decisions, the disciplined, patient investor stands ready to capitalize on the opportunities that arise. Keep your head down, manage your expenses with extreme discipline, maximize your automated contributions to VOO and SCHD within your Roth IRA. And understand that true financial independence is built slowly through daily habits rather than sudden market gambles. Time in the market will always be your greatest ally. Hit that subscribe button. Peace.